The question here is what is liquidity and why does it matter? What is liquidity and why does it matter? Number one here is introduction to liquidity in the markets. Introduction to liquidity in the markets. Liquidity actually is the ease with which you could buy or sell shares in the market, without causing any significant change in the price, without causing price fluctuation. That is what liquidity is all about. If you could very easily buy and sell shares in the market, no matter the volume you are buying or selling, without significantly causing any price fluctuation or changes in the price level, then that particular stock is considered to be highly or sufficiently liquid. Number two, how liquidity works in the stock market, how liquidity works in the stock market. So in this case, you consider buyers and sellers. Buyers and sellers. Liquidity depends on the presence of enough buyers and sellers, at any given time, ensuring that orders could be filled quickly at the expected price. You have enough buyers at the buy column, you have enough sellers at the sell column, so that when you issue a buy or sell order, a buy or sell mandate, it will be executed quickly, without delays. Not only that, you look at market depth. Market depth refers to the ability of the markets to sustain large orders without impacting the price significantly. That's what is called market depth. That is, that you could execute a large buy or sell order without, impacting the price, without affecting the price, without causing fluctuation, in the markets. So that is what market depth is all about: the ability to absorb the market's ability to absorb large orders without price fluctuation. Number three is factors that influence liquidity. Factors that influence liquidity. We have trading volume. Trading volume. The more the trading volume, that the market could handle or the stock will handle, the more liquid the stock is. So the more the volume we can handle, the more the liquidity, of the stock. As it can, it indicates greater activity taking place in that particular stock without significantly affecting the price. Not only that, you look at market makers and brokers. Market makers and brokers, equally influence liquidity. So in this case, these entities facilitate liquidity by offering to buy and sell stocks. Generally, they are always there, to the offer to buy and the offer to sell, even at large quantities, and they keep the market, liquid almost at all times. So you also look at types of stocks. Large cap stocks are known to be highly liquid. Stocks like Amazon, stocks like Tesla, stocks like Apple, they are more liquid than small cap stocks, because small cap stocks could be less liquid. They are not as liquid as large cap stocks. So types of stocks is very, very important when it comes to determinant of liquidity. Number 4 is why liquidity matters. Why liquidity matters. Please like this video and subscribe to this channel if you've not done that. Why liquidity matters. For investors, actually, it has to do with quick execution. It matters because if the stock is highly liquid, it guarantees quick execution. If you key in a sell or buy order, your order is executed almost instantaneously because of the level of liquidity. And not only that, it lowers the spread. If a stock is highly liquid, the bid-ask spread is lowered. In the case of an illiquid stock, the bid-ask spread is wider, and the wider the spread, the more the transaction cost. That's for investors. Then for market efficiency, liquidity is very, very important, not only for investors, it's equally important for market efficiency. So in this case, there's an accurate pricing. Liquidity helps to reflect accurate price by matching supply and demand efficiently. Whenever there's sufficient liquidity, it will help to match demand and supply effectively, efficiently. But if there's no liquidity, there could be much demand with not enough supply. There could be much supply with not enough demand. Not only that, there's a reduced volatility. The more liquid a stock is, the lesser the volatility in that particular stock, because large amount of sales or buy order will not cause the stock to fluctuate widely. So there's a reduced volatility. Then for risk management, there's that easier, exit strategy. It's easier to exit your investment or to exit the trade, the stock. So investors can exit position without worrying about significant price changes or losses. You can very easily key in your sell order and exit the market without worry that you may not be able to exit at the price you want, you wish to exit. And there's less slippage. The risk of getting a worse price than expected is minimized, in a liquid market. Slippage simply means, buying or selling at a price you intended not to buy or sell because of less liquidity in the stock you are trading in. And number 5 is illiquidity and its risk. The risk attached to illiquidity. There is the price impact. When a stock is illiquid, you can hardly sell or buy at the price you want to sell or buy, and that will lead to unexpected losses. And not only that, there's a market crashes. Low liquidity during time of stress, like in the global financial crisis, can exacerbate market decline. In the case where there's less liquidity, it caused the market to decline lower than necessary, lower than expected, or lower than normal. So there's a difficult exit. You find it very difficult to exit your shares. You want to sell, no liquidity, no sufficient buyers. You have to shelf the sell process for some time, because you look at the buy column, discover that there are no sufficient buyers to be able to absorb what you want to sell. You see, so these are the problems, the risks that are attached to illiquidity in the markets. Number 6, example of liquidity in action. Example of liquidity in action. Highly liquid stocks like Tesla or Microsoft, can be traded in large quantities with minimal price distortion. Example, illiquid stocks such as certain penny stocks or small cap companies may experience large price fluctuations due to lower trading volume. The lower the trading volume, a stock can accommodate, the larger the fluctuation it might, experience. So in conclusion, the importance of liquidity is ensuring efficiency, low cost, as well as risk mitigated, stock trading. So it's important in the market to have sufficient liquidity, or else, trading becomes very difficult and efficiency may be lacking, in a market where liquidity is lacking.